Following a series of failed takeover attempts by BHP Group in 2024 and 2025, Anglo American has pivoted toward a strategy of simplification, characterized by its pending merger with Teck Resources and the divestment of legacy assets. This analysis examines the multifaceted investment thesis for Anglo American, evaluating the bull case centered on its emergence as a copper pure play and the bear case rooted in jurisdictional volatility and the structural decline of the diamond market.
The bull case, a critical minerals powerhouse. The bullish outlook for Anglo American is predicated on the successful execution of its Anglo-Teck strategy. This transformation is designed to unlock material value by focusing on high-margin Tier 1 assets while capitalizing on the projected structural deficit in the global copper market. The Anglo-Teck merger and the strategic capture of Copper Alpha. The centerpiece of the bullish thesis is the merger between Anglo American and Teck Resources. By combining assets, the newly formed Anglo-Teck will offer shareholders more than 70 to 80% exposure to copper. The strategic rationale is not merely based on scale, but on the exploitation of geographic and operational adjacencies. In Chile, the integration of Teck's Quebrada Blanca and Anglo's Collahuasi operations is expected to generate $1.4 billion in annual average EBITDA potential.
Beyond operational synergies, the merger is underpinned by a robust financial framework. The merger structure involves a share exchange ratio of 1.3301 Anglo American shares per Teck Resources share, alongside a $4.5 billion special dividend distribution to Anglo shareholders. Analysts have established a valuation framework for the merged entity at approximately £57.90 per share, which incorporates the base merger value, improvements at Quebrada Blanca, and the anticipated copper production increases. This valuation suggests a re-rating as the company sheds its diversified discount and moves toward the higher multiples typically afforded to pure-play copper producers. The regulatory pathway for the merger, while complex, has seen progress. The approval under the Investment Canada Act in December 2025 was a milestone, achieved through concessions such as maintaining the global copper headquarters in Vancouver. This alignment with national interests, particularly in North America, provides a strategic floor that was absent in previous hostile bid attempts.
Operational efficiency. The second pillar of the bull case is Anglo American's demonstrated ability to deliver operational efficiency through its Future Smart Mining program. By the end of 2025, the group achieved its targeted $1.8 billion run rate cost savings program, showcasing a disciplined approach to expenditure during a period of portfolio transition. This efficiency is reflected in the group's high margin performance. In 2025, the copper business delivered an EBITDA margin of 49%, while the premium iron ore business recorded a 43% margin. Technological integration serves as a primary driver of these margins. The Future Smart Mining framework encompasses step-change innovations in how minerals are sourced, mined, and processed. Key technologies such as SandLix, a precision mining and processing method, have demonstrated recovery rates exceeding 85% in pilot scales, even on primary ore. Furthermore, the adoption of autonomous haulage systems, robotic drilling rigs, and AI-driven blast optimization is projected to increase productivity by up to 25% across global operations by 2026. Tier 1 asset quality and cash flow inflection points. The third component of the bull case focuses on the specific quality and trajectory of the company's core assets, particularly Quellaveco and Minas Rio. Quellaveco, located in Peru, is expected to reach a critical capital payback milestone in 2026, just 4 years after its first production. Despite navigating natural fluctuations in its grade profile, the mine maintains a consistent output of approximately 300,000 tons per annum at a low unit cost, transitioning from a capital-intensive development phase to a major cash generation focus. In the premium iron ore segment, both Kumba in South Africa and Minas Rio in Brazil have exhibited resilient operational performance. Minas Rio, in particular, received a 4% upgrade to its 2026 production guidance, reflecting embedded operational improvements. The focus on premium iron ore, high-grade products that command a price premium, insulates the company from the volatility of lower-grade markets and aligns with the global steel industry's shift toward lower carbon production methods.
Furthermore, the crop nutrients business, anchored by the Woodsmith polyhalate project in the UK, offers a long-term growth option. The strategic partnership with Mitsubishi Corporation, announced in early 2026, involves Mitsubishi investing in the feasibility study and potentially taking a 25% stake in the project. This deal validates the marketability of the Poly4 fertilizer product and provides a de-risked path toward a final investment decision anticipated in 2028, with Woodsmith eventually positioned to generate significant cash flows for decades.
The M&A floor and structural market tailwinds. The final bullish pillar is the valuation support provided by recent M&A activity and long-term commodity fundamentals. The series of bids from BHP Group, culminating in a $53 billion or 34 per share offer, effectively established a floor for Anglo American's market valuation. The Anglo board's rejection of these premiums was based on the conviction that the tech merger and the subsequent internal portfolio simplification would deliver better risk-adjusted returns. This rejection signals to the market that the company's assets, particularly its Chilean and Peruvian copper operations, are viewed as nearly irreplaceable. From a macro perspective, the transition of the copper market into structural deficit conditions in 2026-2027 provides a tailwind. While demand is projected to grow between 2.5% and 3% annually, supply growth remains constrained below 1%. This imbalance, exacerbated by the material demands of global electrification, is expected to drive inventory drawdowns and sustain copper prices well above historical norms. The merged Anglo-Tech entity is uniquely positioned to capture this premium.
The bear case: structural obstacles and execution risks. Despite the compelling transformation narrative, Anglo American faces significant headwinds that could undermine its valuation and operational stability. The bear case centers on the degradation of the diamond market, fiscal instability in key jurisdictions. Investors is the status of De Beers. Once the cornerstone of the Anglo-American empire, De Beers has transitioned into a significant liability. In 2025, the unit recorded an underlying EBITDA loss of $511 million and prompted a $2.3 billion pre-tax impairment. This follows a series of write-downs totaling $6.8 billion over the past 3 years, reflecting a permanent structural shift in the diamond industry. The primary threat is the rapid adoption of lab-grown diamonds, which now command nearly 50% of the U.S. engagement ring market. With lab-grown stones priced at an 80–90% discount to natural equivalents, the traditional luxury positioning of natural diamonds has been severely eroded. De Beers' attempts at containment, such as the Lightbox brand, were shuttered in 2025 as lab-grown prices fell below De Beers' own floor. The divestment of De Beers is proving far more difficult than the sales of other assets. The process is complicated by the 15% stake held by the government of Botswana, which maintains sovereign control over the critical Jwaneng and Arapa mines. Any prospective buyer must navigate a complex web of African government relationships and commit to significant expansion capital, a requirement that has limited the pool of interested parties. The ongoing sale process, characterized by a dual-track approach, has been delayed by the deterioration of the diamond market, creating a persistent drag on Anglo American's total group performance.
Jurisdictional volatility and the Chilean fiscal squeeze. Chile remains the heart of Anglo American's copper production, yet it has become a source of increasing fiscal and regulatory risk. The 2024 mining royalty law, which enters its full implementation phase in 2026, imposes a 1% ad valorem tax on sales and a margin-based component ranging from 8% to 26%. For large-scale operations like Los Bronces and Collahuasi, the maximum total tax burden can reach 46.5%, significantly higher than the taxes paid by competitors in other jurisdictions. This fiscal pressure is compounded by a new fuel tax introduced in 2026, which targets the mining sector for 74% of its total cost. This is estimated to add $100 million in costs over a 6-month period. Such selective taxation, combined with wage inflation for a skilled workforce and the necessity for expensive desalination infrastructure, is eroding the competitive advantage of Chilean assets. Furthermore, the permitting environment in Chile has become a bottleneck for growth. Prolonged timelines for transmission, storage, and water projects have hindered the ability of miners to ramp up production quickly. While the government has proposed fast-track mechanisms for major investments, the overall trend of 2026 mining investment in Chile shows an 8.8% decline, suggesting that capital may be fleeing toward more stable regions. South African logistical paralysis and infrastructure decay.
The South African operations, primarily represented by Kumba iron ore, are affected by the systemic failure of the National Logistics Network. Transnet, the state-owned rail and port operator, has suffered from years of underinvestment and operational decline. In 2023, logistical constraints limited iron ore exports to 55 million tons, costing South Africa its position as a top 3 global exporter. While the government has launched the National Logistics Crisis Committee and approved $1.3 billion for infrastructure overhaul in 2026, Transnet consistently fails to meet its own recovery targets. The reliance on a failing rail system has a direct impact on Kumba's profitability. Even when global iron ore prices are high, Kumba cannot monetize its production if the arteries of the economy are blocked. Analysts from UBS have maintained a sell rating on Kumba iron ore, citing these persistent logistical risks despite the company's high-grade product quality. Additionally, the cost of power in South Africa continues to rise rapidly, and the lack of a modern electricity grid further constrains the development of new projects.
Macroeconomic divergence and near-term copper surpluses. While the long-term copper narrative is bullish, the near-term market balance for 2026 presents a risk. Goldman Sachs has revised its 2026 copper price forecast downward to $12,650 per ton, citing a projected global surplus of 490,000 tons. This adjustment is driven by weaker global demand growth expectations and an energy price shock that is expected to shave 0.4 percentage points off global GDP. Furthermore, the demand for iron ore remains heavily dependent on the Chinese property sector. Chinese steel production fell 14% year-on-year in January 2026, and port-side inventories of iron ore reached record highs of 179.5 million tons in March. If the Chinese economy fails to stabilize its real estate market, the premium commanded by Anglo American's iron ore products could compress, impacting the cash flows needed to fund the company's broader transformation.
Conclusion. The bullish case is anchored on the merger with Teck Resources, creating a critical minerals champion. The rejection of the BHP bids has set a clear valuation target, and the capital payback at Quellaveco signifies a turning point for the group's free cash flow generation. However, the bear case highlights the difficulty of divesting a legacy portfolio during a period of structural disruption. The $6.8 billion write-down on De Beers is a reminder of how quickly crown jewels can become liabilities in the face of technological change. Jurisdictional risks in Chile and South Africa, ranging from 46.5% tax ceilings to a total rail system failure, create a ceiling on the company's valuation re-rating. Ultimately, an investment in Anglo American at this juncture is a bet on management's ability to execute the Teck merger and the subsequent pure-play re-rating before the structural decline of diamonds and the logistical hurdles of South Africa erode the company's capital base. While the long-term structural deficit in copper provides a favorable backdrop, the path through 2026 and 2027 will be defined by the separation of De Beers and the navigation of the new Chilean fiscal reality.